which really disappointed in terms of performance today was Hexaware Technologies. That stock was under pressure, but it remarkably recovered to end just with a tad bit of a negative bias. Reema joins in to tell us what the street made of the performance and what the performance as a whole looked like. Reema.
Yes, very disappointing set of earnings from Hexaware. The stock is now corrected 30% from its 52-week high of 298 that it hit in August of last year. And today's fall has come in on very large volumes. The key problem has been the miss on the top line. So the company's revenues contracted by 2% on a quarter-on-quarter basis, and the revenue growth for the company has been slowing down. 4 quarters ago, the revenue growth was at 5.5%, and now it's a negative growth. The management indicated it was an unexpected drop in revenues from a couple of their clients, a slow ramp-up in a few deals, as well as the calendar effect or seasonality. With respect to margins have come down from 16.5% that it used to enjoy 3 quarters ago, now down to 12.9%, and it was the higher ESOP cost which hit their margins this quarter, as well as a couple of extra factors like visa as well as medical expenses, and that flowed through into the profitability as well. Nomura says the numbers were materially below their expectations. However, if the company can sustain the dividend yield, then it could cushion the stock price. But after you make an interim dividend payout of 2.5 rupees per share, the company will be only left with $33 million of cash, and then they see it's hard, they find it hard that the company will be able to sustain these kind of dividend yields, which is why they have a cautious stance on the stock. Morgan Stanley says that the biggest driver for the miss was an account of the revenue. The only silver lining that they could see was the employee addition.
Thanks, Reema, and here's what the